Welcome to this webinar where we ask what will it take for Equinor to become Paris aligned. This webinar is arranged by the Norwegian Climate Foundation, Norway's green think tank. And my name is Anne-Karin Sæther. I'm a project manager leading our project on oil and gas. And today we are pleased to present a report by the Australasian Centre for Corporate Responsibility, ACCR. ACCR is a research and shareholder advocacy organisation assisting institutional capital to understand investment risks and opportunities in the energy transition. And ACCR has made a report called Equinor's Challenge: Which Way to Paris? The backdrop is that Equinor itself claims to operate in line with the Paris Agreement. According to Equinor's energy transition plan, the company is focused on actions consistent with a 1.5-degree pathway. And the main shareholder, the Norwegian state, is arguing that Equinor's long-term value creation supports the goal of the Paris Agreement. Other shareholders disagree, and we'll hear why later in this webinar. But first, I'm very happy to introduce ACCR. Welcome, Alex Hillman. Yeah, it's morning hours.
This morning.
Sorry?
Thank you for having me this morning. It's great.
Yeah, it's morning hours here in Norway, but you're based in Australia, so I'd rather say good afternoon.
Yeah, it's about 4 o'clock in the afternoon in Perth, where I'm based.
Yeah, you're the lead analyst in ACCR, and you have degrees in finance and chemical engineering. You have spent many years working in oil and gas in companies like Woodside Energy and BP, and you have a deep understanding of asset and company forecasting. We are looking forward to your presentation of the report. So please, the digital floor is yours.
Okay, thank you very much. As you mentioned, we prepared a report, Equinor's Challenge: Which Way to Paris? And probably the key takeaway is that the financial returns that Equinor has generated outside of Norway have been lackluster. And by ceasing the development of those projects and global exploration, Equinor can move significantly towards Paris alignment without diluting shareholder value. So, as I said, our two key recommendations is that Equinor should halt development of unapproved projects outside of Norway. We think this is because none of the projects, unapproved oil and gas projects outside of Equinor is looking to develop outside of Norway, are Paris aligned, and neither are they low cost. Over the last 20 years, Equinor's international segment has significantly underperformed its local assets. And with the IEA projecting peak in oil and gas demand before 2030 in every one of its published scenarios, generating value from the oil and gas sector is not going to get easier over time. In terms of exploration, we found that Equinor's exploration is actually reducing access to capital to fund the energy transition rather than providing the financial muscle that Equinor claims it is. By implementing these two recommendations, our analysis shows that Equinor could reduce its emissions from pre-approved projects, including exploration, by 81%, which is a significant step towards Paris alignment. So if we consider Equinor's Paris alignment to start with, Equinor says that its energy transition plan is aligned with the Paris Agreement. We disagree. So most of Equinor's emissions are Scope 3 emissions, and the only aspirational target that Equinor has, including Scope 3 emissions, is the net carbon intensity target. So we don't agree that an intensity target is a good measure of Paris alignment, because in order to fix climate change or to mitigate climate change, we need to reduce absolute emissions. So measuring intensity, we don't think is a good starting place. But even if you have a look at Equinor's ambitions for 2030 and 2035, according to Equinor's own disclosure, it is significantly higher emissions intensity than the International Energy Agency's only Paris-aligned scenario, the NZE. So we don't agree the metric is the most useful metric. We don't agree the ambition is steep enough. And then when we had a look at their strategy, so we built a model of Equinor's future emissions and carbon intensity. We assumed in this model that Equinor meets the upper end of its renewable and its CCS targets for 2035. And we still found that Equinor cannot meet, we don't see any way that Equinor can meet its 2030 ambition. And we think the only way Equinor can meet its 2035 ambition is by significantly reducing the investment into new oil and gas. Equinor did present a slide at its last Capital Markets Day about how it planned to meet its climate ambitions. I think the first thing to note is completely consistent with our analysis is Equinor didn't present a plan for how it's going to meet its 2030 net carbon intensity ambition. It just spoke about its 2035 ambition. So that graph there is a screenshot of Equinor, so exactly how Equinor presented its plan to 2035. And like I said, we've given Equinor the benefit of the doubt for the renewables and its CCS projects, but we got a few comments on the rest of the bars that Equinor is looking to use to meet its 2035 target. The first bar, optimize oil and gas portfolio. As we understand it, that refers to divestment. Divestment doesn't reduce emissions. What it does is it moves emissions and production between balance sheets. So you can't meet the Paris Agreement and you can't mitigate climate change by moving emissions and assets between balance sheets. It would also be a breach of the Greenhouse Gas Protocol, which is an international greenhouse gas accounting standard, to treat that divestment as a reduction. So if you go down to the bottom right of the graph, there's also this decarbonised energy step. So decarbonised energy, as Equinor presents it, is a blue hydrogen step and a gas power with CCS. So if Equinor has some gas and it has some CCS that it can deliver, then converting that gas into hydrogen is not 100% efficient. And so by doing that, Equinor actually has less energy that it can sell. And so our analysis shows that if Equinor does convert its gas into blue hydrogen, it's going to reduce its NCI relative to selling gas on its own and selling CCS as a service to third parties. And also, in order to implement blue hydrogen or produce blue hydrogen or implement CCS on gas power, you need additional CCS. So this suggests that Equinor is going to exceed its CCS target, which we're not aware of any disclosures suggesting how that's going to balance out. And then in the last wedge, or the last bar, Equinor says that non-energy use will increase. We had a look at the International Energy Agency's scenarios and found that by 2035, it's likely to increase by about 2%. So that is a real impact, but it's unlikely to be material. And then the other thing mentioned in that last bar is customer leaders. So Equinor says that refers to offsets. Equinor quite rightly in its scope 1 and 2 ambition says that offsets shouldn't be a key driver of that. So we're a little bit surprised to see, material, not a large, but a material reliance on offsets in its NCI ambition. So one of the things that Equinor says is that because it has low scope 1 emissions intensity, it deserves a larger share of the future carbon budget. So I think the first thing to acknowledge is Equinor's scope 1 emissions are actually very low. So full credit to Equinor for that. But scope 1 emissions are just a small part of the value chain. And when you have a look at the impact on life cycle emissions from those lower scope 1 emissions, we find even though there's a dramatic reduction in Equinor's scope 1 relative to the industry, it's only a 13% reduction in life cycle emissions. So it's not nothing, but it's not super significant. And this is in the context of the International Energy Agency saying there's no room for new projects at all. So having lower intensity doesn't create room in the carbon budget for new projects, and therefore it's a bit moot about the impact that Equinor's scope 1 emissions have anyway. So there's a few problems that ACCR has with how Equinor has assessed its Paris alignment. We've developed our own methodology. We think it's really key when you assess Paris alignment to start with climate science. So effectively what we do at a high level is we start with the carbon budget. In most of our analysis, we use the International Energy Agency's NZE, net zero emission scenario. And then we look at the commodities. So we look at the the demand or the consumption of that commodity within the NZE, and then we see if an asset or a project is cost effective enough to fit within that carbon budget or that portion of the carbon budget allocated to that commodity. And so there's a number of benefits of this. It means divestment becomes moot because the definition of Paris alignment occurs at the asset level as opposed to the corporate level. So changes to the corporation structure don't matter. And it also avoids any opportunity for an oil and gas company to self-select a target that suits its strategy. And so some of those problems, they're quite evident. So there's a number of oil and gas companies in the world, especially European super majors, that say they're Paris aligned. But despite this, emissions from the oil and gas sector have increased since the Paris Agreement was ratified in 2016. So, some of those problems that are leading to this is that divested emissions are treated as reductions, intensity targets are being used, and then base years are being selected by companies that suit a company's portfolio. And so when you can select a base year with higher emissions, that exaggerates the impact of any reductions that do occur. So to build our method up from start, so, like I said, what we do is we start with the NZE and we look at the commodity. So this view here, it's Rystad data, and it's the oil production of every producing and post-FID field. So every producing field on the left, and then on the right, we've added every project which has reached final investment decision. So these are projects that are under construction and all the capital has been sunk. And we assume that the producing and the approved projects will preferentially run to end of life. And then what we do is we have a think about what's the additional capital allocation step around unapproved projects. And so those yellow bars that we've added to each year, what you've got to imagine is that within each of those yellow bars, there's a cost curve. So the cheapest projects, which are more likely to be consistent with the Paris Agreement, will be at the bottom of that, and the more expensive projects at the top. I'll come back to how that impacts Equinor's portfolio in a moment. The graph on the right shows, how this all comes together with the carbon budget, because that's the oil demand in the net zero emissions pathway. So that green line over there. And what you can see is that producing and approved projects already provide more oil than is consistent with the NZE scenario. So that means we don't actually need any unapproved projects, and we don't therefore see how a company can justify investment in new oil and gas as still being consistent with the Paris Agreement. What we've got here, so the graph, the shaded colours look slightly different because this is for gas now. And what we've done is we've overlaid Equinor's actual projects or its potential imminent final investment decisions for major gas projects. And so you remember within that yellow bar, you imagine a cost curve where the cheaper projects are at the bottom and the more expensive projects are at the top. So what we can see here is that Equinor's projects, they're well above the green line, so they're not needed to provide gas supply in the NZE. But even within that yellow band, they're in the top half. So even if there was room for new gas projects in a Paris aligned scenario, Equinor's projects wouldn't be the first projects to be selected because they're not the cheapest projects. Another way to think about the value created by these projects is to look at how much value they create for Equinor and Equinor's shareholders for each tonne of emissions. So when you look at these three projects, they create $2.30 of NPV for each tonne of Scope 3 emissions. So, anyone who's familiar with carbon pricing, that's a ridiculously low, that would be a ridiculously low carbon price. And so when you think about the cost-benefit analysis of these projects, the amount of value they're creating versus the effort and the expense that other parts of our economy are taking to avoid emissions, they're just vastly disproportionate. So the value of these projects is so much lower than the costs society are already bearing in large parts of our economy to avoid emissions. When we have a look at oil projects which Equinor may make FID on or may invest in, so again, all of these oil projects are above the green line, so none of them are Paris aligned. Equinor does, however, have some relatively cheap projects. So if there was some room in the carbon budget for new oil projects, some of them would be at the cheaper end of the spectrum, which could arguably be justified. Though that more cost effectiveness or the greater cost competitiveness of these projects is reflected in the value created by these projects. It's $12 of NPV for each tonne of Scope 3 emissions. So again, there's very few places in the world, there's very few major carbon markets where carbon is priced below $12. So we're still not seeing that these projects are generating more value than society is willing to bear to avoid emissions. That's the climate side of things. We've had a look and I've explained, our view on Equinor's claims around its Paris alignment. And I've also presented ACCR views these things. Possibly, another really interesting aspect of the research we put out, however, is a financial analysis of Equinor's international portfolio. So we had a good look at this portfolio, again using Rystad data. And we looked at every international project dated back. I think the earliest one was even before that. There's a few even before Equinor's IPO. And what we found is that Equinor has spent $14 billion to acquire these opportunities and to mature these opportunities to NPV. So it's $14 billion just to get to the point where these investments could be made. From that point, Equinor spent almost another $100 billion, so $94 billion developing these projects. And the net outcome of that $94 billion is to erode $3.6 billion of Equinor value. So when you consider it's $14 billion for the opportunity to erode another $3.6 billion, there's $15 to $20 billion of value that Equinor has eroded due to its international aspirations. And so we've spoken to Equinor about this. We've seen their recent disclosures. One of the things that really shines through is that they're saying they're focusing and they're targeting their international exploration and that they're narrowing their focus. And they present this along with some very attractive looking returns. I think in the international portfolio, they're talking about 3.5-year paybacks. But this isn't a new claim. This kind of disclosures around how profitable international portfolio and international projects are going to be is a regular feature of Equinor's disclosures. Just to pick one example, in 2013, they were saying that the international portfolio was going to have a 3-year payback, assuming $110 oil prices. So in 2013, that $110 oil price was significantly above the market futures price. Today, Equinor is talking about oil price assumptions, which again, well above market futures. So although Equinor is saying things are going to get better, they've been saying things are going to be well for a long time. And, and our analysis of the data suggests that it hasn't gone well. When we presented this information to Equinor, the response was that they don't recognize these numbers. So what we did is we had a look at Equinor's own financial statements, and we pulled out 20 years worth of data for Equinor's Norwegian segment and compared it to its international segment. So the graph on this slide has the only analysis that ACCR has done is to take a 20-year average of data that Equinor has produced. So this is entirely Equinor's own data. And what you can see is that on an average over the last 20 years, Equinor's international portfolio and its Norwegian portfolio has had very close to $30 billion of non-current assets. Within Norway, those $30 billion of assets have generated $20 billion of net operating income each year. And so it's an astounding return on these Norwegian assets. Internationally, however, you can see that the return has been much, much lower. So the same asset base has generated 1/26th of the value of the Norwegian assets. So I think this supports the analysis on the price screen, suggesting that Equinor's international assets have been really capital intensive and have not generated significant or, in our view, any shareholder value. So one of the little things we tested was, possibly there's just been a really bad performer. Maybe, the United States, Equinor did put out, a very frank report about some of the problems faced with its United States operations. So we assessed its international portfolio by country, and we assessed it by project. When you look at the graph on the left, half of the projects that Equinor has invested in, so half of the countries where Equinor has invested outside of Norway, have eroded value. So United States is the worst performer, but it's definitely not the only one. When you look on the project level, when you look at the projects with over $1 billion of Equinor capex, most of them have eroded value. So there's no single bad apple that we can see, or there's no single reason that Equinor's international performance is so poor, suggesting that if there's a problem that can be fixed, where they could just move on and start generating value. So if we step back, a fair way and have a look at the sector generally, what we find is that the oil and gas sector is a chronic underperformer. So this data is MSCI data. There's no ACCR analysis here. It's just MSCI data comparing the 10 highest level sectors and how they performed over the last decade. And what you see here is that's the tech sector along the top. So tech sector has boomed. It's generated a huge amount of value over the last 10 years. The dark black, the dark black line is the global average. So this is the global equities average, total shareholder return over 10 years. And you can see 8 bars or 8 lines clustered around that. So there's so after tech has outperformed every other sector, there's 8 sectors that are grouped quite closely together. And then along the bottom is the energy sector. So the energy sector is 99% oil and gas. And as you can see, it's not just the lowest performing sector, it's almost an outlier in terms of its performance over 10 years. And similar, the graph shows 10 years, but a similar conclusion is drawn over 15 years. When you have a look how Equinor has performed, so Equinor over 5, 10, and 15 years has outperformed that energy sector. But it's but over the cycle, for the 10 and 15-year period, it's still significantly underperformed the global equities. So I think what we're seeing here is Equinor has outperformed the oil and gas market, not by enough to keep up with the general share market. But within Equinor, we've got this massive disparity between its Norwegian operations, which have generated a huge amount of value, and its international operations, which in our analysis has eroded value. But the world is changing, and the energy transition is accelerating. So just last year was the first time that the International Energy Agency had all of its scenarios showing a peak in all of the 3 fossil fuel commodities, in oil, gas, and coal, before 2030. And they reconfirmed that in the recently published 2024 World Energy Outlook. So while when we reflect on the history, Equinor has no particular role, especially outside of Norway. When we have a look at how the markets, the pressures that the market's going to face into the future, they're likely to be stricter. It's going to be harder for Equinor to generate value into the future. And the projects that it's making or looking to make FID on imminently are unlikely to start up before 2030. So developing a major project could take, 5 years is not unreasonable or not unusual. So we're talking about major projects, if they do reach FID, starting up into a declining market. It's never a nice place for a commodity producer to be operating. So we spent a fair bit of time thinking about the international developments, and then we've got a few slides talking about exploration as well. So Equinor has a website dedicated to answering the question is why, as a climate-focused or climate-conscious oil and gas company, they're still developing oil and gas or exploring for oil and gas. So the first reason they give is that Equinor needs financial muscle to support the energy transition. So that's their phrase, is financial muscle. So we again turned to Rystad data. We had a look at all the cumulative cash flow from undiscovered resources within the Rystad data set. And so I'm definitely not pretending, and Rystad wouldn't claim that they can at all predict how any individual exploration activity is going to go. But they have algorithms modeling entire regions and basins, and over a large portfolio. We think there's some insight to be gained from this. And what we find is that when you add up the cumulative cash flow from undiscovered resources for Equinor, it doesn't generate positive cash flow until after 2050. So while Equinor is saying they need to explore to find more resources to generate cash to fund the energy transition, what we find using Rystad data is they're actually going to have less money available until after 2050. So you can't support a transition to net zero in 2050 if you don't have any more money available until after 2050. I should note for those economists or finance people, this is undiscounted. So this is just cumulative nominal cash flow. Obviously, if you discount these amounts, the time taken to break even extends significantly. So it is a long time. So, so 25 years or more than 25 years until cash flow positive. Even if there's a really, unexpectedly positive discovery, however, it takes 13 years. Equinor it is closely aligned with the international oil and gas market. It takes about 13 years to go from discovering a resource to starting production. So even if they find a massive resource tomorrow, it's going to be 2037 on average before Equinor is generating any revenue. And if they're exploring in multiple fields at the time, obviously any positive cash flow they get from one asset is going to have to offset and fund the operations at other assets. So we think even at a project level, supports the conclusion that at a portfolio level, we're unlikely to see cash being generated by further exploration. The other reason that Equinor gives for continuing exploration is that we need safe and stable energy supply. So again, we tend to Rystad. We had a look at total cumulative production of undiscovered resources, or oil and gas resources by Equinor. And what we found is that most of that is produced after 2050. And so our conclusion from this data is that rather than providing safe and stable energy supply to support the transition to net zero in 2050, Equinor's exploration is likely just to lock in fossil fuel consumption beyond 2050. So we think this is likely to hinder the energy transition as opposed to support it. Related to energy security and the transition, I'm Australian. I haven't spent time or much time in Europe, but I am aware that obviously with the Ukraine war, the European energy market has gone through significant upheaval in recent years. And Equinor and Norway in general does deserve credit for being a reliable supplier of energy through this period. And Europe needs to continue to have a reliable supply of energy into future years. We're also making some fairly, some recommendations which significantly deviate from Equinor's strategy. And so we've had a look at what impact that would have on future emissions from Equinor's portfolio and future gas production and gas supply within Europe from Equinor's portfolio. And what we find is that when you look at the whole portfolio, let's start with when you look at pre-FID production. So this is the emissions and the production associated with capital that hasn't been deployed yet. Our recommendations would avoid 81% of those emissions and that production. So that's the basis of us saying that Equinor can materially move towards Paris alignment without hindering or eroding shareholder value. When you include Equinor's operating assets, what we find is that total production, total emissions are reduced by 39% on average or cumulatively to 2050. And that's that red line in the top graph. So you can see energy production and emissions would stay relatively stable until about 2030. They drop off significantly through the mid-2030s and end up about 75% lower in 2050. So there is a material reduction in energy, but in our view, that's more consistent with the Paris Agreement. But coming back to this European energy security issue, when we just look at the portion of Equinor's portfolio that is gas production in Europe, our recommendations only decrease that European gas production by 7%, and they have very little impact until 2030. So that red line along the bottom is showing it's about 100% up until 2029 or so, and then drops to about 75% by 2050. So we think that's consistent with the type of accelerated energy transition that Europe is progressing at the moment. And that is my presentation. So over to you, or back to you, please, Anna.
Thank you, Alex. That was really interesting. So to sum up, no more exploration, not in Norway, not abroad, and no more investments abroad. Yeah?
Exactly right. So they're quite simple recommendations. And we see huge opportunity to reduce emissions and protect Equinor's value in the process.
And you're based in Australia and you're focusing on this Norwegian company, Equinor. And in the, or at least among oil companies, Equinor is considered to be a leader in the energy transition. Why are you focusing on this company?
So I think there's probably two reasons. Firstly, because Equinor does seem more committed to the energy transition and to climate change than many other oil and gas companies. We think they've taken a leadership position, and we think they're more likely to take this sort of step than other companies. And secondly, the financial analysis is just so compelling. Like, the oil and gas sector is associated with high returns, and one of the things that surprised me so much leaving the oil and gas sector is that there's pockets of the oil and gas sector which actually haven't generated value. And I think this perception we often have as a society that we need to trade off economic benefit and climate protection. In this case, it's a win-win. Like, there's an opportunity to stop eroding value while mitigating climate change.
Yeah. Thank you so much. And before we move on, I need to add that we have invited Equinor to comment on the report and on his presentation, but they were unfortunately not able to join us today. But nevertheless, thank you so much, Alex Hillman. Earlier this year, at Equinor's annual general meeting, a group of investors urged the company to increase the pace of its low-carbon transition and ensure that the strategy and investment plans are consistent with the Paris Agreement goals. And this group of different investors was led by Sarasin Partners, a London-based asset management group. And we are grateful to have one of the partners in Sarasin Partners with us today, Natasha Landell-Mills. Welcome.
Hello.
Hello.
Thank you for having me.
Besides being a partner, you are a certified financial analyst and head of stewardship in Sarasin Partners, aren't you?
Yes.
And if I'm right, and for those not familiar with the term, stewardship is the use of investor rights and influence to protect and enhance overall long-term value for clients and beneficiaries. Is that right?
That's right, yes.
And you are here to comment on the report and to tell us why you submitted the proposed resolution for Equinor's annual general meeting this year. Please go ahead.
Great. Thank you very much. First off, I'd just like to commend ACCR for that incredible presentation, but also the work that has gone into it. I know it's taken a whole lot of time and resource, but I think what's really, really important about this report is it's probably the most rigorous financial analysis, at least that I have seen, of oil and gas companies' sort of forward-looking CapEx plans that starts from the perspective of actually meeting the Paris Agreement goals. So you have quite a lot of analysis in the financial markets from brokers and others that are looking at oil and gas companies in a lot of detail, but very few of them look at it through the lens of achieving a 1.5 outcome or take seriously, I would say, the threat of decarbonization that we see happening before our eyes. So I think the ACCR report is incredibly important, and it should be one that is used as a model globally to look at other oil and gas majors. But we're here to talk about Equinor. We, as you mentioned, led a group of co-filers of a shareholder resolution at Equinor's last annual general meeting, their AGM, in May. This was really the culmination of 3 years of engagement between a large group of investors. I'm a co-lead on something called the Climate Action 100 Plus initiative, which brings together like-minded institutional investors who are committed to promoting 1.5 alignment. And as you said, with regards to the definition of stewardship, the reason for this is that we, as long-term investors, understand the very material economic threats from climate change, the physical impacts of climate change, and therefore see very clearly that it's in our clients' and members' interest to promote corporate behavior that would be aligned with a safer climate pathway, a 1.5 pathway. So it's very much around protecting value and economic prosperity into the future. Now, you can take that down to individual companies such as Equinor, and clearly oil and gas companies have a particular role here. So our resolution at Equinor was very much saying, look, in this case, actually, Equinor is a leader. They have very clearly said that their ambition is 1.5 degree alignment. And really importantly, the state, the Norwegian government, is a 67% shareholder, so really basically calls the shots, if I can put it that way, is also committed to 1.5. They're a signatory to the Paris Climate Agreement. So from our perspective, Equinor was a very good and safe place to invest in the oil and gas industry from the perspective of being a leader in transitioning away from fossil fuels into a cleaner energy future. And of course, as we've heard, that will take time, and over that time, there will be considerable cash flows that will benefit shareholders. So they have this ambition, that's very good. But when we looked at their plans, their CapEx plans, as we've been hearing, we were not convinced. And in fact, Equinor itself says in its transition pathway, they demonstrate how their planned emission reductions sit above what would be considered consistent with 1.5, and indeed even above, up to the year 2030, what would be consistent with well below 2 degrees. So there was this disconnect, and our resolution sought to put the spotlight on that and ask the company to go back and to strengthen its strategy so that it was indeed aligned with 1.5. You can read our resolution online. There's a lot of detail in there as to why we wanted to do this, but we obviously used the work from ACCR. In addition, I would say, we use some very important disclosures from Equinor itself on capital at risk. Buried within their financial statements, they make some really key disclosures as to their sensitivity or their exposure to write-down risks. And this is the existing balance sheet. So not looking at those forward-looking projects that we've been hearing about from ACCR, but for their existing asset base, they calculated that in a 1.5 pathway, you'd see $10 billion write-downs. That's equivalent to about, at that time, 20% of their equity. So, there's quite a lot in there to say that we really need Equinor to take proactive early action to build resilience to decarbonization, protect shareholders, protect the planet, and I would add actually to protect Norway, with regards to ensuring that there's a smooth transition. What you don't want is Equinor, and indeed the country, Equinor is very big, I know, within Norway, to be deploying lots of valuable capital into infrastructure and assets that then are not used, because that doesn't only harm the economy, but it will harm ultimately employment. Equinor is a very big employer today, but we need new jobs for the future, and taking a kind of backward-looking approach, which I think we would argue is taken, for example, in their accounting assumptions, is putting that future potentially at risk. So that was our rationale. I would, if I have a couple of moments, maybe just mention how we're thinking about next steps at Equinor.
I was about to ask, so thank you.
May I do that?
Yeah.
Okay, super. So firstly, to say that we had the structure of the resolution, over 30% of the non-state aligned votes went in favor of our resolution, which in the world of voting at AGMs is a very high percentage. You don't often get that kind of, I guess you could call it a protest vote. But of course, the government didn't vote for our resolution, and our resolution was specifically crafted to say we'd like Equinor to align with what the government has asked it to do, which is a 1.5 pathway. So we were disappointed with that. But nevertheless, what was important about that decision by the government, because of course, if they'd voted in favour, we would have won that resolution. But what's important about it is their rationale. Their rationale was very explicitly around the fact that Equinor has committed to 1.5. So therefore, the government, taking that at face value, is supportive of that. So looking ahead, what we need to do is, in our view, again, expose that the strategy, while the ambition is 1.5, the strategy is not. It's not going to get Equinor onto 1.5 pathway. What I think the company means when it says they're 1.5 supportive is that they could get onto that pathway if they needed to. But currently, as they describe it, society is not on that pathway, so it's not up to them to show that leadership. That's where I think we would disagree. We would like them to show that leadership for all the reasons that I have set out. So looking ahead, what we're doing is continuing our dialogues with the company and with the board as far as we can get access. We are particularly interested to encourage more board directors to join Equinor who have energy transition experience. We think that is critically important because without that leadership at the top, it will be very hard, we think, for Equinor to take these bold decisions. And in addition, we are very keen to address this point of what 1.5 means and being very clear and honest with the market as to what Equinor means. Because right now, investors are taking decisions based on statements such as we are supporting the Paris Agreement, we are aligned with the Paris Agreement, or even more recently, we are compatible with the Paris Agreement. And yet, as we have discussed, we don't believe that is the case. And this is really a matter, it's very traditional financial market regulation. To ensure the integrity of the markets, you need to have reliable information on which investors can make those decisions. And we think this is part of that. So we'd like to see the financial regulators look at this and make sure that the markets have a very clear view of Equinor's position on its 1.5 alignment. Maybe I'll just end, because I don't want to take up too much of your time, by saying this is not just, again, about Equinor, but Equinor has an incredible opportunity to show leadership in this industry, and it is incredibly well placed. Norway has generated huge amounts of national wealth from its oil and gas reserves, and we'd just like to see it transition to show that leadership going forward in a clean energy future. Thank you.
Thank you. That was a clear and good call. Thank you. And I know you have a busy schedule, so I'm really happy that you had the time to be with us today, and good luck with your further work. Natasha Landell-Mills, thank you.
Thank you very much. Bye.
Our next guest is also Australian, like Alex Hillman, but he lives and works in Oslo, in Norway. Welcome to you, Glen Peters.
Thank you. Nice to join you.
Peters is a senior researcher at CICERO, Centre for International Climate Research, and a worldwide authority on the carbon cycle and emission scenarios. And you're on the Global Carbon Budget Leadership and Core Teams. And you were a lead author in one of the scenario chapters in the last assessment report from the International Panel on Climate Change. Thank you for joining us. You are here to give us some information on what is needed to be Paris-aligned and to comment briefly on the ACCR report. And a while back, you wrote an op-ed in the Norwegian daily Aftenposten, arguing that people should watch what Equinor and Norway do and not only what they communicate. I guess you'll touch upon that as well. We're all ears. please.
Okay, thank you for the introduction and nice to join you. Yes, I had an op-ed in the Aftenposten a few months ago, as you said, watch what they do, not what they say. And I think that's a sort of a good thread for the two presentations we've just heard. So I hope to bring together, I guess, in a way, the two presentations. I'm going to talk about oil and gas extraction in Norway, focusing on Norway. And you will see from Alex's presentation, if you focus on Norway or international or different areas of the world, you may get different answers. So this is going to be specific to Norway, and I hope to come with 5 lessons based on some scenarios that were produced for Norway. So here are those scenarios. They were produced by the government body, the Norwegian Offshore Directorate, giving 3 potential pathways in the future on how oil and gas production might go in Norway. So on this figure here, you see historical production in the black line. So it's grown quite rapidly up to around about 2000, and then it's been relatively flat for the last 20 years. Then you see these 3 scenarios branching out, and these scenarios are meant to sort of explore some of the challenges, opportunities, and so on in the years ahead. So just quickly touching on those scenarios, there's the red one at the top, which is a high resource growth and quite strong technological development. It also has production being maintained out to about 2035. This is also a goal of Equinor. Is that realistic? I'll touch upon that as we go through. But some of the key points in this scenario, it requires a big focus on new frontier areas with multiple major discoveries in the Barents Sea, for example, which is a relatively poorly explored area at the moment. If you go to the other extreme, there's a low scenario. This low scenario essentially requires a dismantling or leads to a dismantling of the oil and gas sector in Norway, which, many people will start to get worried about that and sound like we're going to not have any lights or anything in Norway anymore. But as they state, this scenario will still contribute a significant value creation in Norway over the next decades. So it's not actually a bad scenario from the income perspective. So just the first little message based on these scenarios: even if dismantling the oil industry, Norway will continue to bring in significant income from oil and gas production. So Norway is going to do just fine, is the first message. The next point is to look at what investment is needed in these different pathways. So this is a very similar figure to before, a little bit different in style, but it's got the historical production in the grey. These 3 scenarios, they're in grey now, but just sort of going out into the future. And the brown part just goes up to 2035, and it's showing different types of oil reserves and resources that are needed to meet these different pathways. So the dark brown there is oil and gas coming from existing reserves. So this is areas where there's a platform now, and that oil is being extracted and sold. Additionally, to follow this low pathway, you would need new investment to extract some of the oil and gas in regions around existing fields. So these are fields, so we know there's oil and gas there. It's close to existing infrastructure, but it just requires some investment to connect it up. That's not always easy. I've put down 2 little fields there. You probably can't read the text, it's okay, but there's 2 relatively big gas fields in Norway close to existing infrastructure, but it's actually very expensive to get that oil and gas, but because it requires some new technological development just because of the characteristics of the different fields. The fields are called Pion and Lindorm. That's required just to follow this low pathway. If you want to follow this base case, the middle scenario there, you additionally need to get resources, oil and gas from discoveries, so areas that's been discovered. It's not exactly sure how much oil and gas is there. It's not necessarily connected, or no platforms there, and so on. An example there would probably be the Wisting field in the Barents Sea, where the oil and gas is there. There's been some developments, but not final investment decisions yet. Additionally, you would also required to find new oil and gas that's not yet been found, so some new discoveries. This is all just to meet the base case. So if you want to keep production at current levels, as Norway wants to do and Equinor wants to do, you're going to have a very aggressive exploration particularly in new areas. This is also outlined in the scenario description. So it's not that easy. It's actually, you could question whether it's really feasible to keep production up at that level out to 2035 and beyond. So the next lesson I want to touch on is higher oil and gas production would require opening new fields that are costly and technology is not yet developed. This is a figure here showing US oil production just because it's a little bit nicer. It's a bit more dramatic. And it was thought that US oil and gas production had sort of peaked around about 1980 and it had a decline of roughly 20 years. And then production took off again. This is because of investment. The main innovation there was investment in technology, horizontal drilling, and so on, which allowed to access oil and gas that thought was not accessible, shale gas and so on. And now oil and gas production in the US, or production in this figure, is much higher than it was before. So the point I wanted to make here, I should say also with the Wisting field, another issue with opening new fields, such as Wisting, and they talk about this in their scenarios for Wisting, is having a new field there. The first one costs a lot of money, but then you open up access to a new area, new infrastructure, and so it increases the value of the oil and gas already there. And so you could see the similar situation in Norway if you open up aggressively in an area like Barents. These scenarios would change, and there could be a dramatic increase in oil and gas production in Norway. So the third lesson, investment is to increase future production and enables high production levels in the future, and it changes the potential scenarios into the future as well. When we want to look at Paris aligned, we often look at scenarios. This can be a little bit complex. This figure here shows a bunch of different scenarios that are consistent with 1.5 degrees, just showing oil. In the blue here, we have oil scenarios from the scenarios assessed by the IPCC, and in the green, the IEA. One of the challenges with the scenarios assessed by the IPCC is they have a very big range. I've just put the bars there so you can get an idea of the range, and you can almost get whatever answer you want. But these IPCC scenarios are really looking at trade-offs, different factors driving different questions, research questions, and different things going on. It's not focused particularly on what's going on in the oil and gas sector. The IEA scenarios are much sharper, much more focused, and there's just one scenario. And as they say, this quite powerful phrase, if demand drops in line with 1.5 degrees, there's no need for new oil and gas fields. So there could be new oil and gas, but that would imply in their wording that you would have to close down existing fields. So it starts to get complex. But overall, no need for new oil and gas. So the fourth lesson, if you follow demand trajectory in line with a 1.5 degree world, it leaves no room for new fields of oil or gas. And just finally, Norway and Ecuador both talk about the global picture, what's going on with the global market and so on. Although in reality, Norway primarily sells to Europe, and Europe does not want oil and gas into the future. Of course, there's short-term various constraints related to Ukraine and so on, but the EU wants to be Paris aligned. It has a pretty strong 2030 target and net zero target in 2050. It wants to get out of oil and gas over the next decades. The main point here I wanted to make is it's demand driven. The EU, which is the demand source, does not want oil and gas in the decades ahead. However, you still might want some supply side policies to ensure, for example, that new areas are not opened and expanding the oil and gas facilities and leading to stranded assets. And that's all I wanted to say, but I'll just leave with this little figure at the end, which sort of links a little bit to the watch what they do and not what they say. And everyone says that they're Paris aligned, but they are still investing in coal, oil and gas. And if you're investing in coal, oil and gas, then you are not Paris aligned. And I'll finish up there. Thank you.
Thank you, Glen Peters. That was 5 valuable lessons. One short question. Can't you invest in anything new if you are to be Paris aligned?
There's scope to invest in activities around existing infrastructure. And you can see many reasons for that. Maybe it's a little bit cheaper, lower emissions to get something around existing infrastructure. But if you invest in new areas and open up new infrastructure, then you're just opening a whole big area of new future oil and gas, which is definitely not needed. Okay,
I hope people took notes, but we'll share all PowerPoints with the audience later. Thanks again.
Thank you very much. It was a pleasure.
Then we are moving towards the end here, and we'll get Alex Hillman back in for some final remarks. So, what do you make of these comments from Sarasin Partners and CICERO, Alex?
So it was great to hear their perspectives as well. The work that Sarasin Partners is doing with the engagement side of things is extremely powerful. We've put out research which we think is useful, but in order to change Equinor's strategy and its future emissions profile, that engagement with the company is really important. And then Glen, it was lovely to hear a familiar Australian accent. I did not expect to see that in a Norwegian webinar. But that climate perspective, really fleshes out what we're talking about. We're talking about international assets as the low-hanging fruit. But obviously, in order to be Paris-aligned, we fully support Glen's perspective that there isn't room for new oil and gas assets to be developed anyway.
Okay, thanks again, and thank you to all speakers, and thank you to everyone watching today. This is it for now.